Hi friends, it's Tracy from the Financial Freedom Diary, and today in this Sip and Serve video, we're going to be talking about interest-only payments for those of us who are beyond the grace period. We are in our repayment plans, whether we graduated or not, don't matter, because the rule is pretty much the same, and it's especially for those who are doing the income-driven repayment plans, IDR. I'm doing revised pay as you earn. I'll make sure I leave a link to studentaid.gov so you can see the 4 different types of IDR. I'll also make sure that I include the NerdWallet interest calculator link below. And in the card of the video, I'll make sure I include my link to my video where I talked about capitalized interest, because I did go into it and talk about the scenarios in which that would happen. If you're new to my channel, please consider subscribing below, and I hope you guys enjoy the video. For example, we're going back to January 2020. These are the last 5 loans that I will be paying in 2021. We're going to look at them from the way they look back in January of last year. So the principal balance has been rounded up, and I'm only using the whole numbers. I'm not doing anything with the decimals. And so that's why it looks higher than what I have to pay now. My monthly interest, the total is $244.28. And if you look at my monthly payment, it is $199.34. So if you're in a situation like this, where your monthly payment and your interest don't equal, you need to make an extra payment, an interest only payment. And that's just to maintain. Okay, that's just so that you just don't keep building up that interest, because it accrues every day. It's hard to catch up with when you're looking at it on the website, but you do want that interest only payment. And so that's what we're going to see next, what mine would be broken down per loan. Okay, so for calculating my monthly interest, I did use NerdWallet again, and I will make sure that I link the website below. And all I need for that website is my interest rate, my principal, and the number of days. Because that tool uses whole numbers, I just pulled my whole numbers from here. And that's why I round up. For my number of days, I go with the maximum number of days that's possible in a month, which is 31 days. Because if it's a 30-day month and I got a little extra 2 cents going to my outstanding interest or to my principal, I will take it. But here I have calculated what do I need to cover my interest. And the way that I did that was I subtracted the monthly payment from my monthly interest. So for Fed Loan P9, I need $28.21, but my monthly payment is $25.76. So I'm going to add $2.45 to that particular loan. The total I need for the month for everything is $44.94. And so the question for me becomes, do I have $44.94 to just make that payment? If I do, then I go in and I make that payment. I decide which check is going to come out of, and I make that payment. I typically do that out of my very first paycheck. And so when I go into Fed Loan, I target specific loans. I find my loans that I want to put the interest payment on. So I look for number 9, because remember, the letters are the things that the identifier that I came up with. And so I will put 245 to number 9. And then I'll move on to 771 for number 16. And then I'll go down my list. I want to make sure that the total that's in their site matches the total that I have for my interest only payment. So I went back and I added an extra column for the outstanding interest. This is what we see when we log into our loan servicing provider's website. And when we're looking at our account, we always see an outstanding interest, and that number changes every day. On one of my loans, I think it's T20, I probably accrue $2.70 something per day on that one loan. So I wanted to make sure I put that in so that way when we talk about what we're doing as far as when we're making our interest only payment or we're not going to make our interest only payment, you understand that that outstanding interest column is what's going to be affected. So in this scenario, I went back, got one of my statements from last year, and I put that outstanding interest in here. And so the total is $78.21. And so if I choose not to apply an interest only payment, then whatever I accrued for the month is going to be added to what was already outstanding. If I didn't make that interest only payment in January, this is what February would look like. You see my outstanding interest has increased for each loan. And so instead of it being $78.21 as my total, I now owe $123. So you see how it just builds up over time. You just keep adding on to it, keep adding on to it, and then you need to recertify. So if I chose not to do the interest only payment, by the time my recertification period comes around, what they're going to do is they're going to take my current principal, add it to the outstanding interest, and then I'm going to get a new principal balance. They're going to charge me the same interest rate, but on that new principal balance, which means that I'm going to be paying more in interest. So let's go over our options. And our very first one is to make our minimum payment only. In this case, this is where you have the largest amount of interest that's not covered per month that can be applied to your principal when it's time to recertify. The next option is that you make a partial interest only payment along with your minimum payment that normally comes out. In this case, you're reducing your outstanding interest that's going to be applied to your principal balance. And then the next option is you can make the full interest only payment along with your minimum. And so therefore you're not keeping a lot rolling. You're still accruing every day. So it's going to be minimal what's going to be added to your principal compared to the other two options. And then the best option to me, and the one that I do, is I make my minimum monthly payment. Then I do my full interest only payment, and then I do a little extra. In that case, in some situations, I am able to pay my interest, pay whatever is outstanding, and then also a little bit will hit the principal. In this example, we're going to model the best case scenario that we can do under an income-driven repayment plan. And so you'll see that I have my monthly payment, which is $199.34. I also have my interest-only payment, which is $44.94. But this time I added a new column called Extra, and the sum of my interest only plus my extra payment. So for the extra, I just decided I want to apply $100. I believe you guys helped me come up with that number, but I'm going to break that out across 5 loans because theoretically I'm actually snowballing a whole nother debt. So let's pretend I'm paying off another credit card or something like that. So I'm going to reduce that snowball. That $100 that would have went to the credit card is going to go to my student loans. I hope that makes sense. And so I'm putting 20 per loan. And so in the case of the very first loan, Fed Loan P9, it's going to be $245 plus $20. And so that payment's going to be $22.45. So when I log in every month to make that payment, I will go in and say, okay, target specific loan, and then put in $22.45. In this scenario, what I needed to cover my monthly interest was $28 and some change. I'll have more than that. And so I will cover that interest. I will take care of the $9.01 in outstanding interest, and then a little bit can actually be applied to my principal. For T20, it'll be a little different. I will have enough to cover what I would have accrued in interest for the month, and I'll be able to put some to my outstanding interest. I won't be able to eliminate it or pay any to my principal. In this example, I am just snowballing my student loans. I don't have any other debt. And so you'll see that I still have an extra payment of $100. I still have an interest only payment of $44.94. I still have that total payment of $144.94. But look at Fed Loan T20. I have increased what I'm going to apply there. So the 245 that was on P9 is actually been added to T20. The $20 extra that was for P9 has been added to T20. And since I have that extra money going to that particular loan, that actually helps me to be able to cover the interest that would have been accrued that month, be able to cover the outstanding interest, and to be able to put a little bit to the principal balance. Now, someone else may look at that and they may say, no, I don't want to do that. I want to keep the $245 and the $20 and put it with the snowball to apply to the smallest student loan. That's okay. You also can choose any of the other ones and put that money to them or split it out across all of them. It's whatever works best for you. Do that. And I change it up from time to time. So I don't have one set way that I go about doing it. I'll just say, okay, how would this best benefit me, especially ones that I'm not seeing the movement when I check my statements. In your monthly budget, you want to make sure you're taking care of your necessities first. So you want to make sure you're covering your rent and mortgage, your food, medication, utilities, transportation, miscellaneous categories like insurance or daycare expenses. And then you have your debt. In my case, it's my student loan payment. I need to make sure all those things are done first. And then after I finish that, I add in a line item for my interest only payment and any extra that I want to pay. And then after that, whatever money I have left goes towards my debt snowball. Okay, so this is what things are looking like for me in February of 2021. There's one more debt payment that I need to make for the month of January. I haven't done my budget, so I can't tell you how much it's going to be, but I have adjusted my principal balance for all of my loans to reflect the rounded up version of what the principal is today. And so right now, my outstanding interest is zero. My outstanding interest is zero because I had been doing my standard monthly payment along with my interest only payment with a little bit of extra in there. So when the CARES Act started, what happened, I had already done my interest only payment and then they took out my monthly payment. So I ended up with zero in my outstanding interest. Let's compare my monthly interest to my monthly payment. My monthly interest now is going to be $225.06, and my monthly payment is $251.66. So now you see my payment is higher than my interest. So I don't need to do an interest only payment, but I am opting to still put $100 to the other loans that are not part of my snowball. So in February, my snowball is going to be applied to Fed Loan P9. And so I'm going to apply $25 to the other loans. Now let's say I get P9 paid off in January. I haven't done my budget, so I don't know yet. But if I am able to get that paid off, what I'll do is I'll start on Q16 in February. I will take that $25 that I'm putting in extra on that one, and I'm going to split that across 18, 13, and 20. So two of the loans are going to get $33.33, and one loan is going to get $33.34. And that's going to help reduce my principal. And so once it's time for me to look at my statement, I will be able to see the principals are now moving on all of my loans and not just the one that's a part of my snowball. Finally, some things to remember. Don't ignore your monthly statements. I like to download mine, print them off, and then I do the highlighting thing and I make a comparison between the two. I try to understand why I see slight differences in my outstanding interest, and then I just file my stuff away. But just pay attention to those things because they do have like your notifications when it's time to recertify. You want to make sure you're in the habit of checking your inbox so that way you know what messages are out there, you know what's available to you, and you're ready and you're armed with what you need. And you want to make sure that when you get your recertification notice, that you go ahead, go over and take care of that on time. Because if you don't recertify on time, what they do is kick it back to whatever the original payment should be. And if you're set up like I am, where they take the payment out automatically, then they're taking a bigger payment out than what you expect. So that's why you want to make sure you're checking that box. You see, you got to take care of your paperwork, do all that stuff on time because it's all electronic now. And so it's a lot easier than faxing. And then also put your interest only payment in the paycheck or paychecks that work for you. When you see me doing my budget, you'll see that my first paycheck is where I take out my interest only and anything extra. And then the second paycheck is where my monthly payment comes out of. But that works for me. You may want to split yours across your paychecks. Do what works for you. Now, I know I went over quite a bit of information. And as far as the options, if you really want to know, I actually went through every phase of that. So I wanted to make sure I presented that to you guys because you guys see me at number 4. But you don't know that I actually went through the first one, the second one, the third one, and worked my way up to the fourth one. And so I wanted to make sure I put that out there so people would know you don't have to start at a certain point and then get discouraged because they can't do it. They can only do the monthly payment right now as they try to get all their debt under control. We all start at different points, and it's okay as long as we're continuing to move forward and we're not paying down debt in one thing and building up debt in the other thing. It's hard to see progress when you're doing that. So if you have any questions for me, let me know in the comment section below. If you haven't had a chance to subscribe to my channel, please consider doing so. I hope you all have a super fantastic, peaceful day, and I will talk to you guys again on Thursday. Bye.